Millionaires, and welcome back to another episode of attempting to turn 10k to 100k over time. So today I was sitting by myself having lunch and was pondering and about my investment philosophy, and if I could summarize it into a phrase or something like that to make myself grounded into this style and philosophy, and to ensure that I do not stray from it and just invest in anything that makes me uncomfortable, which would ultimately steer my emotions and lead to bad investment choices. So I was thinking for a bit, and I think I settled down to one phrase, which is called "look into the future." So I chose this phrase because I want to invest in companies that are either dominating today and will continue to dominate going ahead. So I just making this video to document my thoughts, and perhaps you could gain some value or two out of things. So how to think about investing for me is by looking into the future. So when people buy or sell stocks or other assets, right, I feel that we are not just reacting to what's happening today, but instead what's happening tomorrow and maybe 1 year or maybe even 5 years down the line. Everybody's making decisions based on what they think that will happen in the future. This could be the future performance of the company, the economy, or even the world at large. So for example, right, in the short term, this is why during a company's earnings season, revenue and profits of a company could be at sky high, right? The margins could be very strong, but the stock price of the stock can be down. It could just sell down very strongly out of the blue when you see that both revenue and EPS results beat analyst estimates. So why is this the case, right? So always remember that it doesn't matter what the company has done, right? Because a lot of people are talking about how today's markets, because of how liquid it is, how accessible it is, how many participants are there in the market, we are sort of a lot more price efficient as compared to before. So a lot of these things have already been priced in, right? What the company is doing today has already been priced in. So it doesn't matter what the company has already done. It matters if the future looks bright or not. So in the midterm, this could mean earnings performance to some extent, especially if it's a very, very wide surprise beat, right? For example, like a company that invested in, revenue estimates were projected to grow at only 10%, but the company just suddenly reported like a 20% or 30% beat. So obviously, the stock price will gap up on this because the company is actually performing a lot more stronger than what is widely expected, right? Secondly, will be the earnings and guidance and outlook. So is the company expected to perform strongly for the rest of the year? Have they raised their guidance on the full year earnings estimates and revenue sales growth estimates, for instance? So if there is a raise, right, obviously this will be a good thing for most companies. You're expected to perform better, and all your analysts and market participants were caught off guard, and they're now even more certain in your company's future performance and prospects, and obviously they could allocate more capital as a result. Another thing is, I think, your product announcements and rollouts, right? So one company that's very good at doing this is your Tesla. So sometimes you could see that their earnings performance may not beat analyst estimates, but the stock price gapped up after that. But this is because maybe Elon and the team at Tesla announced something new and refreshing. For example, the Optimus AI robots, things like that, which could catch market surprising. They make everybody feel very optimistic about the company's future, what it can do for its customers and prospective clients, how it could potentially upsell or maybe even dominate a certain emerging market. So all of this will help to give the investors a lot of optimism about the stock's prospects, and obviously they will choose to invest into it to seek further capital appreciation, which is stock price growth. Another thing will be fitting to the current narrative of the market. So one good example would be nowadays, right, AI. So if you notice in the past few earnings season, every CEO out there has been talking about AI, how the company will fit in the whole AI narrative, how they can adopt AI, how they can into both their workforce, their workflows, and even their product and service offerings. And I think this will catch the consumers by surprise, retailers by surprise as well, and investors. So obviously, being more optimistic, you will allocate more capital. So for instance, if you think about the most recent ones are like your Not a really good example, but the name that popped in mind is Apple when they announced AI. Like, if I'm not wrong, there was some disappointment to it, right? So it's not always the case where you try to fit in the current narrative. It may backfire. But if you're a company that say like you're Nvidia, your chips are designed for AI, you're saying oh there's a lot more strong adoption. Your Jensen Huang is saying that AI will continue to be drive the growth for the next 5 years, 10 years, massive adoption, things like that. Obviously, your stock price is gonna go up because you're selling your company's prospects. So in the midterm, right, earnings is usually the catalyst for stock price movements. You could use if you've always been eyeing to a stock that's very undervalued, for example, and you feel that it's been beaten down, but earnings season gives it a refreshing new outlook and perspective on the stock. So, for example, it may beat estimates. The company may raise guidance, and also they're rolling out new products and services that maybe could come out and be material to their balance sheet in the next couple of quarters. So all of these are catalysts for turnaround, and yeah, I think, and also right, sometimes it could also give you an opportunity to buy into very solid companies. So for example, Fortinet recently announced their earnings, and then the stock plunged by I think like over 20-30%. So, but Fortinet is a very solid company. It's run by its founders still. Its fundamentals are still very solid. It's growing very nicely, and it's in the ever-growing space of cybersecurity. So if you believe that this is an opportunity for you to add on to the stock, and the next earnings announcement may be better, this could be a chance for you to add on to the stock as well. And then secondly, this is one good earnings article that shows MongoDB stock tanked 23% as ugly full-year guidance overshadows Q4 results beat. Yep, so like I mentioned, what has already happened doesn't matter anymore. Investors only care about the future. And in the longer term, maybe say the couple next one or maybe even 5 years down the line, what will move the stock price will be riding massive trends and technological advancements. So for example, in 20 years ago, it was the internet adoption. If you invested into companies like Google and Amazon back then, which was going against the norm, and they are trying to ride on this new technology called the internet, you'll probably be winning like crazily. Same thing for EV. If you bought into Tesla very early on, and for AI, if we bought into companies like Nvidia, back in 2022, 2023, before the whole ChatGPT product release kicked off the whole AI narrative, right? You probably earn a lot as well. You're probably earning a lot as well. So how do you identify potential technologies and trends that you could potentially invest in to make a massive returns, right? Is to find anything that could make our life easier, essentially, but more specifically, right, any technology and advancements that make things cheaper. So this makes it more accessible to everybody, right? The market expands. There's more people could be using it now, and there's also a cheaper price makes it more willing for people to try it out. Easier to use, again, greater adoption, less barriers to entry to maybe learning the product. Maybe you don't need other tools and things like that to use a certain product anymore. More accessible, as I mentioned earlier, you create a larger total addressable market, and if it makes things faster, right? So I want it now versus I have to wait. So this will allow people to, human in nature are very impatient. So if any new technology can make things faster, for example, weight loss, you take any Ozempic drugs, you lose weight faster compared to exercising and having a controlled healthy diet. So having things faster done for you could be a narrative to invest in. And lastly, enablement. So if you think about the picks and shovel for the gold mine rush back in I don't even know when it was, but very long ago, the picks and shovels will enable the miners to go mine for gold. Same thing for today's age, right? AI enablement. What enables it is the chips, the infrastructure, the data centers. So which is why a companies like Nvidia is soaring crazily. So I think that with this angles to help potentially use it to as a checklist to make sure that the company you're investing in has technology that enable all of these, right? And I think for me also as a something like a warning, right, is to stay away from legacy names and ride on to clear and new emerging market leaders that could be indicated by market share, management and culture, scalability, distribution, and infrastructure. So all of this, I think, if you compare in the past, right? If you invested in a company like Intel, you hold it for like, I don't know, 20 years, right? The stock price is more or less the same. You don't earn anything at all, accounting for inflation. But conversely, if you invest in a company like AMD, right, you're probably riding on a fat stack right now. So why is it that Intel is losing so much out to AMD? So number one, the culture of AMD is a lot different, right? The technology stack that it has, the products it produces are over here, faster, right? And faster compared to Intel's products. Cheaper, easier to use, all that. I don't think it's appropriate here, but it's definitely faster and better, of better quality than Intel's chips, which is why over time you see AMD started to steal market share away from the legacy Intel, right? And you think about it, the tech infrastructure, the management and culture of the AMD is obviously much better position compared to Intel. You have more talents at AMD, right? The patterns, the technological stack is all better than AMD compared to Intel, and this is reflected in the stock price of Intel versus AMD. Another example will be Ford. If you invested, right, probably not earning as much, not earning at all, versus if you invested in the new emerging technology, the EV company like Tesla, you probably earn a lot more. So why Tesla is earning a lot better than Ford, right? It goes back to the same thing: cheaper, easier to use, more accessible, total addressable market. So the whole green narrative, EV actually may be cheaper to use, as in the context of Singapore at least. It is cheaper to use and operate compared to a petrol enabled car, right? Because of our high gas prices here, and there's a lot of people switching to EVs nowadays. And infrastructure, EVs are a lot more smart in nature. There's all this AI computer chips that inside the car. They're more smart compared to your old Ford produced cars, right? So all this is reflected in the financials and also in the share price as a result. But why is it difficult to invest in emerging technology? So I put this as a reminder to myself as well, to make sure that I stay convicted, and try to bet against the current narrative to gain outsized returns. So why is it difficult? It's because number one, as I mentioned, we need conviction to these names, because all these growth companies, right, usually start off from a smaller market cap. You're gonna see a lot of volatility. You're gonna see a lot of media news headline doubting the company's prospect and things like that, which will make you feel like a little shaken off, and maybe you would sell at a loss and things like that before you fully ride out the wave. So you need conviction, and conviction comes from understanding the company's fundamentals and financials. So always keep track with the company's underlying performance in terms of its financials, its earning costs. You have to stick to and get to know what's happening with the company and the industry. Is it taking market share, for example, things like that. Number two, these high growth companies, right? So all of these emerging technological companies will probably have sky high valuations because they are growing at a very a normal pace compared to your market incumbents. So this usually probably leads you to have very high valuation. So if you're a textbook value investor, I think it may be difficult for you to just want to buy into this kind of growth companies at the valuation it's trading at. Probably you'll be put off, and you would rather stick to your value buys, right, which may or may not give you the abnormal returns that you seek from these technological companies. And number three, lastly, you'll be fighting against the current status quo and all the comfort names. So like I mentioned earlier, if you have grown up in the age of seeing Ford's cars around the road, you would think that Ford is a very solid company, things like that, right? You've been using Intel chips since the schooling days, your gaming days, and now into the workforce, you're still using Intel chips. You'll be a lot more familiar and comfortable investing in a company like Intel compared to something new like AMD, for instance, right? So I think we need to always understand why we should invest in technological names, to summarize, and also why and what are the biases that makes it difficult to invest in these names. And if you are seeking outsized returns, you should probably invest in technological advancement, unless you know something about the industry, and then you have the advantage in investing in any undervalued incumbent names. But other than that, I think most retailers are seeking outsized returns should understand that growth names, technological names are the ones that will give you outsized returns. And by the same time, you should understand that the difficulties of investing in such companies and especially the risk involved. So that's all for today. Thank you.